Great. So welcome, everyone. My name is Stephanie Wells, Director of College Relations here at MEFA, and my colleague Dorina Barreto is behind the scenes answering all of your questions today. So feel free to type those in the Q&A, and we're going to get started. We are recording today, so you'll have a link to the recording as well as the PowerPoint slides. If you have any questions, again, please type those in the Q&A. The chat and the raise your hand feature are turned off today. So just to get started, a little bit about MEFA. We are a quasi-state authority here in Massachusetts, self-financing. We're actually a national lender, so we lend to folks all over the country. We'll be getting into the MEFA loan details in a few minutes. But we also do a lot of other work at MEFA, such as savings plans. We run the 2 state savings plans for college here in Massachusetts, as well as the attainable savings plan for people with disabilities. And one of the biggest things we do here at MEFA is guidance and education for families, school counselors, college administrators, community-based organizations, you name it. We are there to do training on all sorts of topics related to the college enrollment process. And we've been around since 1982, so over 40 years. So we have been lending for quite a while. We're probably one of the oldest lenders in the country. So here's what we're going to talk about today. Make sure everybody understands basic loan terminology, but not just what the terminology means, but how does it incorporate into your research that you're doing for education loans. Throughout the webinar, I am going to be hitting home points constantly about being a wise borrower. Not necessarily tricks, but just good advice and guidance to keep your debt low, things that you can do to maybe minimize your borrowing and really understand how borrowing for education loans works. Of course, we'll get into the details of the MEFA loan, of the Federal Plus loan. Those are the 2 primary loans we'll talk about today, as far as family borrowing, as well as the student federal direct loans. But we also want you to understand the timing and the timeline that's coming up, as well as free resources, and make sure that you know where you can go for resources that you can trust. So let's get started. First, we'll talk about the interest rate. That is the number one thing that we want to be looking at when we're looking at any type of loan or credit card or anything like that. That's going to drive the cost. One of the biggest drivers of the cost, I should say. So the interest rate is the percentage that any lender is going to charge you for using their money, so lending you their money. You could have a fixed interest rate or maybe a variable rate, and I'll go through those in a little bit, just understanding the differences, because there are pros and cons to both. Most people do like that fixed interest rate because it's very stable, but some folks like to ride the wave. When variable rates are low, they like to take advantage of that. So it really is upon you to really understand what you're getting into and what's going to work best for your monthly budget. Variable rates do not have caps always on the loan, or the caps on that interest rate might be high. So that's something that we will talk about and show you what you can find that cap on a loan disclosure for a lender. Now, most loans above and beyond the federal direct student loan that you would have seen in a financial aid offer. So we'll take those federal student loans out of the mix for a second here when we're talking about alternative loans or supplemental loans to help pay the bill. So loans where you're taking out to cover what financial aid isn't covering. So those federal direct loans are part of the financial aid package. So those type of loans, alternative loans, are based on, usually the interest rate is based on your credit score. And typically, I'm not speaking for all lenders, I'm really going to use MEFA as the example throughout. MEFA is going to use the highest credit score of everybody that's on the application to get you the lowest rate. So the higher your credit score, the lower your rate. The credit score is one of the biggest drivers, but also the repayment option you choose. That can also drive the interest rate or have an impact on the interest rate. And I'm going to go over that and show you different options for repayment as well, and how that could change the cost of the loan. So you really do want to look at not just that lowest advertised rate. So if a lender sends you a piece of material, you see something online and it says as low as, that's great, but that lowest interest rate is going to go to folks with the very highest credit scores, usually in the mid to low to mid 800 credit score range, which is really high. Excellent superior credit is required to get that lowest interest rate. So you really want to look at that range of interest rate when you're comparing loan options. And assume that you're probably going to fall somewhere in the middle, because most folks fall in the middle range. So if you have a range of 5% to 15%, you're probably going to be, most people are going to be in that 10% range, just using some average numbers. Very few will qualify for that 5% rate, and quite a few will probably qualify for that highest 15%. MEFA doesn't offer rates that high. I'm just using those as an example, because some private lenders and for-profit lenders do charge very high interest rates for those on the lowest, on the credit score tier where they're approved, but getting, on the lowest credit score range. I'll show you a little bit more about that in a second as well. So the annual percentage rate is also a good number to use when comparing loan options, the APR. That's going to be the annual cost of the loan. That will include any fees. So a lot of the alternative loans like MEFA, don't charge fees, at least to originate the loan. The PLUS loan that I'm going to go into in much more detail in a second does charge an origination fee. And even the federal direct student loans do charge an origination fee. So you do want to keep an eye on that. So the APR will take that into account. It's a good, quick way to, compare apples to apples, especially if you're looking at fixed rates versus a variable rate, for example. Now, the repayment term is very important to think about when you're determining what type of loan to take out or what repayment option to choose. The repayment option is going to specify the maximum term that you have to pay off that loan. So most loans in general, you'll want to do your research, but most loans like MEFA, for example, don't have any prepayment penalties. So if you choose to go with a longer term to get a lower monthly payment that you can afford, and think, okay, well, maybe I'll just make extra payments or pay it off sooner, that's a good plan to make sure you have an affordable monthly payment, because you shouldn't have any prepayment penalties. Education loans that are designated education loans don't have prepayment penalties. So you want to make sure that you can pay that loan off sooner to save money on interest if you're able to afford that. The repayment term obviously has a direct impact on the cost of the loan. The further you push out repayment, whether it's a longer repayment term or choosing a deferred repayment option where you defer payments while the student is in school, the further you push out payments of principal and or interest, that's going to increase the total cost of the loan. But of course, you do want to think about that monthly payment. That's one of the most critical numbers to think about, because you want to make sure that that's a monthly payment that you can afford. So, there's flexibility there in your monthly budget. You might be able to afford a higher monthly payment to pay the loan off sooner, or get that lower interest rate if you can do principal and interest payments while the student's in school. But for some families, money's tight right now. They have a couple kids in school, so they might need to do that deferred option. So there's no real judgment here. It's just a matter of understanding the different options and how that's going to impact your monthly payment, because that you want to make sure that you can afford so that you're not late on payments and things like that. And also consider, most of you are probably parents of high school seniors looking at borrowing maybe for the first time. So if you're borrowing the first year, you're likely going to need to borrow for years 2, 3, and 4. So you don't want to overwhelm yourself on a monthly payment for year 1 and then not be able to afford to take on additional borrowing down the road if that's going to be something that's part of your plan. And when you're doing research on your loans, most colleges have some sort of guidance on their website or a lender list that they might work with, a loan comparison tool that they can show you and provide options for you. So you do want to, do your research, make sure that you're getting a loan that's going to work best for you, that's not going to cost you an arm and a leg. You want to make sure you know what your interest rate is going to be, or at least what that range of the interest rate is going to be. But many lenders also offer different repayment options, like immediate repayment while the student's in school, or interest only, or even deferred. So you do want to kind of look at that and see what's going to work best for your monthly budget. So one great way to compare loans, kind of taking away the the marketing and the websites and you know, the language, the sales language that might be on there. You know, every lender's might want to show you, you know, their best lowest rate up front, but you really want to look in the fine detail. And you can find that fine print detail in the application and solicitation disclosure. Every education loan lender has to have this on their website. It's a statement that's going to provide you all the details up front about fees, rates, and repayment options before you even apply. So I'm going to show you that in a second. This can be found on every lender's website. So if you can't easily find it on their website, then that might tell you something. You should be able to easily find it on their website. And many of the loan comparison tools, you might see Elm Select is a very common, popular loan comparison tool that colleges use. You'll see the disclosure statement links are right on there. So you do want to look at, you know, what are the interest rates? What are the fees? So let me show you real quick MEFA's disclosure statement and where you can find that. So right here, we're on MEFA.org on our undergraduate loan page. So I'm just going to scroll down a little bit. So you can see all the details about MEFA's loan is right here. I'm going to skip past the rates for a second here and click on the disclosure tab. So you can see that right there, very easy to find. And I'm going to open up our loan application and solicitation disclosure. Now, every lender has to use this exact template. It's a federal template, and they have to put in their information, the range of interest rates. You can see right here, MEFA has a fixed interest rate loan. It says right here, your rate is fixed. MEFA only offers fixed interest rates, by the way. And it shows you right there on the top what the range of interest rates are, 5.35 to 7.95. Now that rate that you get is going to depend on your credit score and the repayment option you choose. I'll go through the process in a second here. And any loan fees that the lender is charging, you can see here, MEFA doesn't charge any fees, no application origination fees, late fees, none of that. We don't have any fees. But you can also see, and this is really a really good tool to use. Every lender has to provide on this disclosure an example of a $10,000 loan at their highest interest rate for each repayment option. So you can see for each repayment option what our highest rate possible would be. And just as an aside, our highest rate is much lower than many lenders' middle or even lowest rates. It's also less than the Federal Plus rate. But you can see here the different repayment options and what the total cost of that loan would be if you pay it off at the maximum loan term. So that's an important feature. I'm going to do a comparison in a second here. And then there's a second page that shows you what the rates are for the federal programs. The plus loan rate just went up, so I'll go over that in a second here. And any reference notes. So let's take a look at some others. So here I have a couple of fixed interest rate disclosures. And these, you can see the MEFA disclosure right here is on the left. And then on the right, I have a different lender's disclosure statement. So it's a for-profit lender. I won't name names. There's many out there. And I want to point out a few things. So I've just cut out a couple of screenshots from these disclosures. You can see for the immediate repayment loan for me, for the 15-year loan, the $10,000 loan, if you took the maximum term at our highest rate, you'll be paying back about $17,000 for a $10,000 loan. Now, if you look at lender B, for their immediate repayment loan, where you make principal and interest payments while in school, at their highest rate at over 16%, that $10,000 loan is going to cost you over $27,000. So just by choosing one lender over the next, it's costing a lot here. If you look at the deferred option, which is a very popular option for families, with the MEFA loan at our highest rate, little over, it's close to 20,000, 19,856 approximately. And then if you look at lender B, that $10,000 loan for deferred option is over $46,000. That's if you take the maximum loan term minimum payments for those 15 years. So now most people aren't going to be charged the highest rate, but this gives you kind of the worst case scenario that you want to know about. So if we look at the differences here, and this is just choosing, one lender over and next at the highest rate, the immediate repayment loan is costing you over $10,000. The deferred repayment is over $26,500 just by choosing, just the difference between MEFA and a for-profit lender. So if we look at fixed interest rate, I just want to dig a little bit deeper into the disclosure statements. These are not MEFA disclosure statements. You can tell by the interest rates. So here's a fixed interest rate disclosure. You can see their range is 6.49 to 9.99, and it tells you it's a fixed interest rate. Also, you can see the total cost of the loan based for each repayment option. So we just showed you an example of that. And on the left here, you can also see all the different mini fees that this lender charges. Again, these are other lender disclosure statements. So that is a fixed disclosure statement. Now, if we look at a disclosure statement for a variable rate loan, there are a few other things that you might want to look at here. So of course, what is the range of the interest rates? A little less than 2 to 13%. And what the fees are, of course, that's going to be on every disclosure. But very key when you're looking at variable interest rate loans to know what is the cap on that interest rate. For this particular loan, it says the cap is 25%. So this loan will never go above 25%. So God help us if rates are in the 25% range. That, again, that's the worst case scenario, but it's good to know how high it could go. And it also will tell you on the back page, second page of this disclosure, what that variable rate is tied to. So usually it's going to be tied to prime or LIBOR. In this case, it's the secured overnight financing rate. Different lenders do different things, and it will tell you what is added to that rate. So your variable rate could adjust maybe quarterly, monthly, or annually based on that rate. And that means your monthly payment will change as well. So that's a little bit about just digging into the disclosure and doing a little research there. Another thing to think about is co-borrowers. Now, when you're looking at co-borrowers, most families that are looking at loans are looking at a loan that needs some sort of co-borrower, usually with the student. Now, anybody who signs on a loan, whether you consider yourself the primary borrower or a loan you're going to turn over to the student when they graduate, whatever your scenario is or the agreement you have with the student, from the lender's standpoint, anybody who signs on that loan is equally responsible for the loan. You sign your name, you are a borrower on that loan. So that's really important to note. I do get a lot of comments when I'm talking to parents, particularly about lending, and they say, okay, well, we're going to take out this MEFA loan, but it's really the student's loan. It's not my loan. And I always have to remind them that if your name is on the loan, it's your loan too. So you do want to think about that. Now, adding an additional cosigner. So in addition to the student borrower, they're going to usually need a creditworthy cosigner because most students, undergraduate students, don't have the credit built up, or they're not working full time to be able to afford or get approved for an alternative loan. So they will need to add a cosigner. Sometimes adding 2 cosigners can help increase your chance of approval if maybe one cosigner doesn't have a great credit. But even if they're both approved, we're going to be at MEFA looking at the highest credit score to determine your lowest interest rate. So you might have, let's say, dad and the student applying, and maybe dad doesn't have great credit, so they're adding grandma to the loan because grandma has an 850 credit score. So we're going to use that 850 credit score from grandma to determine the rate. So we'll look at every applicant on that loan to determine the rate and use the highest credit score to get the lowest rate. That's how MEFA does it. You'd want to check in if you're searching around. But anybody with good credit is going to help chances of approval and decreasing that interest rate. Another common question I get a lot is, particularly from parents, is can we be released from the loan? And it really depends on the loan and the lender. So most lenders have some sort of co-borrow release option. MEFA has a repayment option that has a co-borrow release after 48 on-time payments. But there's also refinancing available. So MEFA has a education refinancing loan. There's many out there that you can search around after the student graduates and the loans are in repayment. They can look into that. So that's also an option to think about if the student wants to take over any loans. Now, if you're looking at Federal Plus loans, which is only in the parent's name, the student will never be able to consolidate or refinance that loan. The only way you can refinance a loan is to be an original borrower on that loan, to refinance it in your own name. But it is something to think about, down the line after the student graduates. So I'm just going to pause real here and check in with Dorina to see if we have any common questions that are coming through the box, or if I should just keep going.
So I did get one question that I think would be good to answer live, and it's about the MEFA loan. If if they're able to list two co-borrower parents and the student as the borrower.
Yes, that is correct. You can do that. The student is always going to be in the student borrower section of the MEFA loan application. And then you'll have the opportunity to add one or two co-borrowers. So sometimes maybe, both parents will be on the loan, and that way it increases, the chance of we'll use the highest credit score to determine the approval. But sometimes, and this has happened where it's kind of a funny thing where the student might have really good credit, and sometimes they actually have the highest credit score, so we might use theirs. But oftentimes it's one of the parents that have the good credit score, and we'll use that. So you can definitely add two co-borrowers to the loan. Okay, so should we keep going, Dorina? Is that
Just one more question that just came in, I think would also be good. Does the co-borrower have to be a relative?
Good question. Great question. The co-borrower does not have to be a relative with the MEFA loan and with most alternative loans. It could be a family friend, a spouse, whoever they want it to be. It doesn't have to be a family member. With the federal parent loan, the Federal Parent Plus loan, that does have to be a parent. So I'll talk about more in a minute. But as far as alternative loans like MEFA, doesn't have to be a parent in most cases. Great questions. All right, so moving along, and I'll stop again in a minute to see if we have some more good questions coming in. Let's talk about strategy and how do families do this? How do they make the numbers work? So I like to talk about what's called a combination strategy. So not every family is going to do it the same way, and you should do it in finance college or pay for college, whatever is going to work best for you. So I do get that question a lot. Well, what's the most popular loan, or what do most people do? And at the end of the day, what really matters is what's going to work best for you, not necessarily what is everybody else doing. So let's talk about a few different options to pay the college bill. One of them obviously is loans, because that's what we're here to talk about. So let's look at a $20,000 balance as an example. You can look at savings. That's always what you want to look at first. Do you have any college savings set up? Does a family member, godparents, aunts, uncles, grandparents have college savings plans set up? It might just be, a couple $1,000s, but that couple $1,000s can get them books for a semester. So any little amount of savings is going to be great. And it's up to you to decide how you want to utilize your savings. Most families have not saved 100% or even close to 100% of what their bill is each year. So don't, bother yourself or feel bad that you haven't saved all of it, because 99.9% of families who are saving have not been able to do that. And a lot of people just haven't been able to save at all. So you do want to just put that in perspective. But maybe the student's working over the summer. So in this example, student works, they're going to give their parents $1,000 towards the bill. and parents have saved, let's say 16,000 in a 529 plan. So they've decided in this example, I'm going to do 4,000 a year over 4 years out of my college savings plan. So we're chipping away at that bill. And then if you want to use present income, so money out of pocket, out of your paycheck every month, you can look at payment plans. Every college has what's called a payment plan. Most are interest-free and have a small enrollment fee, $50 to $100. So depending on how much you're putting on the payment plan, you can look at that and whether that, enrollment fee is worth the cost. But if you're doing, a $5,000 payment plan, for example, over 10 months, that's going to be $500 a month for 10 months in this example. You don't have to put your entire bill on a payment plan. You can put just a portion of it if you wanted to. So with this example, this family has said, I can't afford to put it all in a payment plan, 10-month plan at $2,000 a month for $20,000, but I can afford $600 a month. So if they were to borrow it all, let's say on a MEFA loan at approximately $100 a month or $200 a month for a $20,000 loan, that would be the minimum loan payment on a loan. But we don't want you to jump right to a loan. You want to look at that savings and present income on a payment plan first. So this family has said, I can afford $600 a month. So they've decided to put some from savings, chip away at that bill, $500 a month on a $5,000 10-month plan. And then they chop their bill in half, still have to borrow for that extra 10,000, but at least they're only borrowing 10,000 this year versus 20. And so there's your affordable $600 payment. You have 500 on the payment plan, $100 on that $10,000 education loan. So it's just a good example. And that's one of the first questions I ask families is how much can you afford per month? I want to know how much they're willing and able to put out per month so that we can take advantage of some of the, lower cost repayment options, for example, or borrow less, put some on a payment plan. We always recommend to borrow, if your family needs to borrow anything, to make sure that the student is taking out that federal direct student loan first. That is the loan that is going to be in a financial aid offer from colleges. You can see the loan amounts here on the right. The maximum a freshman can borrow is going to be $5,500. So there's no credit check. It's a good way for students to take out a loan on their own, because this really is the only type of loan that a student who with limited credit, maybe limited income, can take out without a cosigner. When families say, well, what can the student do on their own? This is the loan they can do on their own to have a little skin in the game and to contribute towards the bill. They can borrow up to about $27,000, and that payment will be about $300 a month when they graduate. So it should be pretty manageable for a student to take on the federal student loans. It's when they start taking on additional debt, maybe graduate school debt or, cosign loans with parents. That's when it can get a little bit difficult when they graduate. Now, the federal loan rates did go up just recently. Every year they're announced in mid to late May, and the rate changes on July 1st. So on July 1st, for students who have a 24-25 loan, so they're going to be, most of you probably freshmen in the fall, the rate is going to be 6.53%. So that is a pretty steep increase in the interest rate. It's based on the 10-month T-bill. So that's, what the federal rate is based off of. Now, some of you in your financial aid offer may see that part of this loan is subsidized, meaning interest is going to accrue after the student leaves school. So that's the best type of loan to get. There's very few interest-free or subsidized loans out there. Not every family is going to qualify for the subsidy. It's really going to be based on the information from your FAFSA form to determine if you qualify for part of that subsidy. Now, if we look at the amounts that might be subsidized or unsubsidized, the unsubsidized portion is going to start accruing interest when the loan is dispersed. Now, no payments need to be made, even on the interest on these loans while the student is in school or deferment. So even if interest is accruing, they don't have to make payments on it. But they really, if you can afford to make those payments, it would be great to do that to save a little bit. So when the student graduates, they don't have that accrued interest that they have to pay as well. So you can keep on top of that interest. It's usually a small amount. You can pay quarterly. It's a voluntary payment. So the subsidy on a freshman year loan could be up to $3,500 of that $5,500 loan might be subsidized if you qualify. If you don't qualify for the subsidy, then up to $5,500 of that loan will be unsubsidized. So anybody who takes out the maximum $5,500 is going to have at least some of it unsubsidized. Now, there is a fee on this loan, an origination fee that's deducted from the loan of a little over 1.5%. So on a $5,500 loan, only $5,441.87 of it is going to be credited towards your bill. So you do want to take that into account. If a loan has fees, is it added onto the loan or is it deducted from the loan? Every student who is taking out this loan will have to go through what's called entrance counseling online through studentaid.gov, so they understand, it's like a little quiz, their rights and responsibilities as a federal student loan borrower. They're also going to be signing their master promissory note for this loan online. Again, no payments are due on this loan while the student's in school, but we do recommend using this loan first, even if parents are going to help the student pay it back, because the rate is typically, very competitive. This year, I know the rates have gone up. It's really one of the highest rates we've seen in a long time. But for the most part, in most years, the rate is fairly low and it's fixed and there's subsidies. There's repayment options, multiple repayment options and benefits, such as forgiveness options for public service loan forgiveness, for example. So you can check out all of those repayment options and benefits on the federal student loans at studentaid.gov. So let's talk a little bit about the process and how these loans work. So I'm going to pivot a little bit to the alternative loans, not the federal direct student loan we just talked about. So when it comes to a MEFA loan, for example, or a PLUS loan, you can borrow up to your cost of attendance minus the financial aid you received. So with MEFA, there's no maximum per se, but the college is going to certify the loan to make sure that you're not borrowing more than cost of attendance minus financial aid. So you only want to borrow what you need. When you're applying for the loan, apply for really the max that you think you'll need for the year, because you can always reduce it. You can always cancel part of it or even cancel the whole thing if you need to. Because you do want to apply for the full year. It is an annual process. You might be applying for a loan each year. You're filling out that FAFSA each year. So you're going to need to do this each year. But definitely apply for the full year. Don't necessarily apply per semester, because interest is not going to accrue on a loan until monies are dispersed to the school. So for example, if you applied for the full year through MEFA, we'll send half usually in the fall and half in the spring when the college designates the disbursement dates. So if you have a spring disbursement scheduled, you're not being charged interest on that until usually December or January when it's sent to the school. So don't worry about, having to pay money or interest on money for the whole year, because you're not paying interest on it until the loan is dispersed. And also when you're looking at that monthly payment for the loan, multiply it by 4 just to give you an estimate of what it might be for your family if you do need to borrow that amount for 4 years. Some families are able to get by the first year or two with just savings and might not need to borrow, but they hit a wall, junior year. Some families need to start borrowing, from the first year on. It really depends on your family's finances and what's going to work for you. But the school, the college that the student's attending is going to certify the loan, usually electronically online. They'll see that you applied, got approved, filled out your promissory note. We send the information to the schools electronically. They certify the loan, they set up the disbursement dates, and then it's credited towards your bill. So you do want to give yourself a little time before the bill's due to apply, even though it is an instant, quick application process. And then MEFA, as with most lenders, we send the money directly to the college. So if you need to borrow for off-campus housing, for example, rent, utilities of the students living in an apartment, or you want to use part of the loan for unbilled expenses such as books or supplies, you can build that into your loan amount. But any unbilled costs, we're sending all the money to the college. They're going to apply it to your billed costs, such as tuition fees and food and housing if the student's living on campus. And then you can get a refund for what's left over. This college can give you a refund for that to pay for those unbilled expenses. Or if you don't need the full amount, you can have the college send any refunds to MEFA directly, and we'll take that off your loan, reverse interest on that refund to lower your loan amount. So there's lots of ways we can adjust the loan throughout the year, working with the financial aid office at the college. So I want to show you a great tool that I use with families all the time. This is MEFA's student loan payment calculator. It's on the undergraduate loan page that I showed you earlier as well. So I'm going to scroll down here. So this is our calculator. So you can put in, I'm just going to put in $20,000. That's the amount that I might need to borrow. I'll show you how this works. I'm going to put in 4 years before graduation, pretending this is a undergraduate student. And as I mentioned, most families fall in the middle when it comes to the rates and credit scores. So I'm going to put myself in the middle here with having very good credit and calculate. So these are MEFA's current rates. We usually reset rates in sometime in June. So we might be resetting rates soon, but these are our current rates. And you can see here, MEFA has 5 different repayment options to choose from. You can do principal and interest while the student's in school, so immediate repayment over 10 or 15 years. If you do the 15-year, you can see that those payments are lower than the 10-year loan. But if you can afford that 10-year loan payment, that's the way to go, because it's going to save you in the total cost of the loan. We also have interest only if you want to make interest only payments while the student's in school, or you can defer while the student's in school. We also have a co-bar release deferred option at the end here. You can see on this chart that the rates, if you look at the second to last line, they go up. The further you push out the loan, the longer you take to pay it back. So you do want to consider that when you're looking at the interest rates. But you also want to look at that third row that is the total cost of the loan. So that is that number that I was pointing out. Excuse me, allergies. Pointing out on those disclosure statements, that total cost, that's, you know, the cost of the loan if you take the full term at minimum loan payments. Now you can reduce that total cost by paying the loan off sooner, making lump sum payments, you know, doubling up your payments, whatever you want to do to reduce that on your own. So just choose, you know, an option that's going to work best for you. But this is a good tool to run numbers. And sometimes when I'm, you know, running numbers with families, I'll say, okay, $20,000, but you said you had $5,000 in a savings account. Let's look at borrowing just 15,000 and see what those numbers look like. And then you can see, you know, what the monthly payments will be for that, and how drastically just taking $5,000 off the loan can reduce your total cost of the loan, as well as that monthly payment. So it's a great tool to use. MEFA is happy to help. We do one-on-one appointments with families to walk them through the process and look at your financial aid offers and help you come up with a strategy. So feel free to, you know, schedule an appointment with us. It's right on our website if you need to, or give us a call. We'll leave you our number and email address in a minute at the end. So let's look at very common questions we get all the time about the MEFA loan and the Federal Direct Plus loan. So the Federal Direct Plus loan is a federal parent loan that you may see on financial aid offers from colleges. Most colleges don't package Federal Plus loans or any loans beyond the Federal Direct Student Loan in a financial aid offer, but some do. So I have talked to parents I've seen the Federal Plus loan on their financial aid offer, you know, high amounts, $20,000, $30,000 loans. And I just tell them, cross that off, add that amount to your balance, and then let's figure out a strategy to pay for it. And the Federal Plus loan might be what you choose to use. So if we look at the interest rates, and again, I'm showing you the current 23-24 academic year rates from MEFA, because we haven't updated our rates yet for 24-25, but I anticipate that we'll have new rates soon. So keep an eye out for that. But if we can, so it's not a true apples to apples because we don't know what the rates are. But if we look at the Federal Plus loan, which just went up, it was in the little over 8%. Now it's over 9%, 9.08%, which is the highest the Federal Plus loan has been in a long time. That's what it's going to be for the upcoming year. The APR, the Federal Plus loan doesn't disclose an APR, but you can see the MEFA APRs. Our rates, as we showed you on those charts, range from 5.35 to 7.95 right now, based on our current rates, depending on your credit score and the repayment option you choose. So no fees with the MEFA loan. However, the Federal Direct Plus loan does have an origination fee much higher than the student loan of over 4.2%. So that is going to be deducted from your loan amount. So if you borrow $10,000, you're not going to have a full $10,000 credited to your bill at the school. It's going to be $10,000 minus that fee. So sometimes families need to borrow more and add on to their borrowing just to incorporate that origination fee. So it can cost a lot more, not just with the fees, but with their interest rate as well. Then a MEFA loan, to put it in perspective. A lot of the private for-profit loans out there, those rates are much higher. But the responsibility for the MEFA loan does fall to the family. It's really a family loan where student and creditworthy co-borrowers are taking the loan out together, whereas the Federal Direct Plus loan is only in the parent's name. So you can't transfer responsibility to the student for the plus loan. With the MEFA loan, we have a co-borrow release option, but also since it's a shared responsibility, both student and co-signers have access to the loan online so that they can manage payments. Now, there are minimum credit standards for the Federal Plus loan. The Federal Plus loan is a good option for families who may have, difficult credit right now. So they've had some credit issues or family finance issues, and that's happened to a lot of families nationwide. And maybe they don't have a 670 credit score, which is the minimum for MEFA to get approved. Maybe their credit score is 630 or something like that. So sometimes a Federal Plus loan can come in handy if families have had credit issues. The enrollment status for the student has to be at least half-time, and there are different repayment options for each loan. The repayment terms for MEFA are 10 or 15 years. The Direct Plus loan is going to set you up with a 10-year immediate repayment option. Now, if you want to, you can ask them to defer the payments. You do have to make that active request. And there's consolidation options with the federal programs where you can spread it out over 10 years. Now, there are consumer safeguards for both programs, which is good. For student total disability or death of the student, God forbid that should happen. Any co-signers from the MEFA loan would be, let go and taken off of the loan. That loan would be forgiven. Or with the plus loan, anything should happen, God forbid, to the parent or the student, that loan is forgiven. Now, you don't need to file the FAFSA to take out a MEFA loan. However, we recommend strongly to file that FAFSA, get that federal direct student loan at minimum, consider eligibility for any other federal student aid or state aid. With the Federal Plus loan, you do have to file a FAFSA in order to take out that loan. So I'm going to stop in a second for questions, but just want to talk about the free resources that are available. Don't be afraid to call the lender and ask questions. We get lots of calls where families really just kind of want to walk through all the questions they have. No question is a dumb question. The dumb questions are the ones that we don't ask. So don't feel, intimidated to ask a lender questions or to ask the financial aid office questions. They are there to help you, to provide a customer service, to help you pay the bill. They want to help make the numbers work. Look for transparency when you're looking on lender websites and comparing different loans. Is it easy to find the interest rate range, different details about the loan? Utilize free resources and guidance. Don't be afraid to go on that college website. They might have loan comparison tools, lenders that they've worked with. At the end of the day, it's up to you as the consumer to pay for college how you want to pay for college. The college wants to make sure the bill gets paid, but it doesn't matter to them if you borrow a plus loan or a MEFA loan, but they of course want you to, keep your borrowing low and borrow loans with low interest rates. So it really is up to you to decide how you want to make this work. So let's talk a little bit about timing, and feel free, Dorina, if you need to stop me to answer any questions. Do we need to stop real quick or can I keep going?
Yeah, we have a few questions
Okay,
here.
let's stop real quick.
One of the common ones is in regards to student loan forgiveness. Um, so in terms of the information that's kind of been circling around, a few people have asked if the MEFA loan or the direct parent plus loan would be in that loan forgiveness option.
Yeah, it depends on what type of loan forgiveness. So I won't get into that level of detail. We do have a webinar recording on our website about federal repayment options. But to answer the question briefly, you can look on studentaid.gov to find out all the different forgiveness options. I threw out the public service loan forgiveness because that's a pretty popular one that we hear a lot about. But forgiveness is in the news. So federal loans in general might be eligible for forgiveness depending on the type of forgiveness and your family's income and situation. So I can't answer it detailed like that. With the MEFA loan, there in any private or alternative loan, there's no forgiveness options per se beyond death and total disability of the student and or co-borrowers. But with that said, if your family is having a financial hardship, whoever you borrowed from, you should work with your lender to see if there's any repayment options or modified payments you can be on until, somebody's lost a job, needs to, get a new job. That might happen for 6 months, maybe make lower payments. Definitely, work with the lender to find something that's going to work for you. Any others that we want to cover now, Dorina, before we keep going?
Yes. Another common question, and I've answered a few, but I thought it would be good to address live, is if they have multiple students going to school, like if they have a sophomore that they've borrowed for already, and then they have a freshman that's going to be starting. The question is, will they be maxed out in terms of borrowing MEFA loan?
Yeah, that's a great question that we get a lot. There's no maximum aggregate loan amount for MEFA. So you can borrow what you need as long as you're approved credit wise, you can borrow what you need because the college is always going to certify the loan to make sure you're not over borrowing more than cost minus aid. So if you have one student, I do want to clarify that it's a separate application for each student because remember the student is a borrower on the loan. But yep, you just apply each year for each student for the amount that you need at each school, and you can borrow what you need each year. There's no aggregate loan amount limits.
And I think I have only two more before we
Okay.
can go ahead and move. So another good question that we got is, does the total cost of the loan include repayment of the principal?
Yes, it does. The total cost of the loan is principal and any interest or any fees that might be assessed.
And the last one is if there are any tax benefits differences in terms of who the borrower is on the loan, so student and parent.
Yep, that's a good question. So there can be tax benefits for education loan interest. So I'm going to refer you to irs.gov for the details on that. But for education loan interest, it doesn't necessarily have to be a federal loan per se, but you do have to be under certain income requirements. Don't quote me on these numbers because go to irs.gov to get the exact number, but my memory serves you have to have as a single filer under 75,000 in income and as a joint filer under 135,000. but don't quote me on that. Check out irs.gov, but there are tax benefits, and typically when you're doing your taxes on TurboTax, for example, they'll ask you if you made payments on student loans. So that's usually part of the tax process. So there could be benefits there.
And actually, Stephanie, there's another question that I kind of see trending here. And in terms of the delays with the FAFSA, a few folks are asking, when should they start thinking about borrowing? Um,
Yeah, that's a great question. I am going to address that now in this slide right here. So
Perfect.
let's talk about that with the timing. And then we'll stop at the end and we'll stay on for as long as we need to answer all the other questions. So the timing, let me go through the timing just in general, and then we can address the FAFSA issue timing, because it's going to be different for different families. So in a typical year for most families, and for most colleges, the bills are going out in June or July and are due about 3 to 5 weeks later in July or August. Now, this year, because of all the FAFSA delays, some of you might be still waiting for a financial aid offer from the college because they didn't get your FAFSA details until recently. So there's going to be some flexibility with the colleges, especially if you're waiting, to e-sign your FAFSA so that the college can get the information and give you a financial aid offer. A lot of people are still going through that mess. Or there's been delays in getting financial aid offers. You do need to know what you're getting in financial aid to apply for a loan. You can always apply for what you think you'll need and reduce it if your financial aid comes through and it is a good package where you can reduce your loan. But you do want to at least give yourself a couple weeks before the bill's due to apply. So it's an instant credit decision to apply for the MEFA loan. You apply online, you find out right away. But you don't want to wait until the night before the bill is due, because who knows, there's identity theft, and some folks have frozen their credit because of identity theft and forgot to unfreeze it. And so there might be some things that you need to deal with. So you don't want to have any surprise information. But be in touch with the financial aid office at the college if you still have not gotten a financial aid offer, just to make sure that they have everything they need. And just to understand, when you might get your financial aid offer, because some of you may not have it from every college, and that is normal in a very abnormal year. So I'll say that. Now, with all these delays, many colleges have extended their enrollment deposit deadline. Many colleges, some to May 15th, which is past, or even June 1st. So if you're still trying to decide where to deposit, you can talk to the college about any flexibility there. And filing the financial aid offer. Colleges are being flexible. Many colleges, because of these delays, may even be giving extended time on their bills or delaying bill due dates. I can't speak for all colleges. It is very individual by school. So check in with your school to find out, what those details are. When you do get your bill, it's only going to be for direct costs, tuition fees, food and housing. If they are living on campus, you can include, unbilled expenses with your loan as well. Be aware that your bill could include insurance. Every student needs to be insured here in Massachusetts if they're going to school here, and many states are the same. If your student is insured under your plan, you don't need to pay $2,000 for the school's health insurance policy. You can waive that. You provide your insurance information, usually online through the college. The instructions should be with the bill. And definitely do that, when you get your bill. Don't wait till the fall to do it, because that might be too late to waive that cost. Your enrollment deposit should be deducted from your bill. Any private scholarships that you've received from outside that have gone to the school, and any financial aid will have been deducted from the bill. Sometimes, depending on the timing, you may even see a payment plan or a MEFA loan deducted from the bill if they've already gotten that information before the bill went out. It really depends on when you apply and the school. Now, work study funds are usually not deducted from the bill. The work study money, if you have that on a financial aid offer, that is a job that the student needs to get on campus and apply for that job. And they'll get that work study money through a biweekly paycheck usually that they can use towards the unbilled expenses such as transportation, books, pizza money, that kind of stuff. So I mentioned, give yourself a cushion before the bill's due to apply. You don't wait last minute. And let's say you don't need money for the fall, but then spring hits and you realize, oh, geez, I might need some money for the spring semester. You can apply for loans at any point during the year. So don't worry about that. You can also adjust the loan during the year. And you should set up the payment plans as soon as you can if you're going to use the payment plan based on the school schedule. So just to wrap things up, and then we'll go back to questions, connect with us on social media, whatever channel you work with. We do have a great podcast. We have really good guests on our podcast. We put all our videos on our YouTube channel, and we're always sharing good blogs and webinars that we have coming up on our other social media channels. So definitely connect with us there. And then if you have questions beyond today, you want to call us. We're open 9 to 5, Monday through Friday. And you can also email us at collegeplanning@mefa.org if you want to set up a one-on-one appointment to go through your bill and, really talk through the MEFA loan options and strategies. We can definitely work with you. So, as a state authority, we're a quasi-state authority, we're self-financing. We are doing the loans at the lowest cost possible and really want to help families reduce their borrowing and pay for college in a way that's going to be most affordable. We offer loans, but they really should be as a last resort. So with that, I am going to open it up for questions. So please type your questions in the Q&A and we will go through that. So let's see here. I'll start going through some of these that I see here. So I have one here that talks about a student who might be in a 5, maybe 6-year program, physician's assistant program, for example. Federal student loans can be deferred while the student is in school, including for graduate school. So a lot of times you might have an undergraduate/grad program where they have 4 years or even 3 years of the undergraduate program and then another 2 to 3 years, could be even an MBA of the graduate program. But the undergraduate MEFA loans at MEFA can be deferred, if you choose the deferred option, up to 5 years. Federal loans can be deferred for as long as the student is in school. So it depends on the type of loan you take out. So that's something that you'll want to look at. Okay, let's see what else we have here. Okay, so we have that question about multiple loans. You do want to, if you have multiple students, you want to do a loan for each student. So good question here. If you obtain multiple MEFA loans each year, does this impact your loan qualification as you apply each year? It could impact your credit score, which would in turn could impact your ability to take out a loan. So it really depends on you and how it's impacting your credit. But that is another reason to just apply for one loan for the full year versus having multiple loans for each semester. That's going to mean multiple hits on your credit. So that's another good reason to just apply for the one loan. And then next year, when you reapply for a new loan, that would also, go on your credit, and any debt you take on is going to impact your credit score. So it really depends on how much you're borrowing, how often you're borrowing, and what your credit looks like of how it will affect your qualification each year. But it could impact your qualification. So question about when would it make sense to refinance a federal parent loan that was taken out last year? You really can just do that right online through studentaid.gov to look at what the interest rates are that you might be able to take out. They have calculators that you can look at, but you do want to look at studentaid.gov about any federal loan information. So good question here about divorced parents, students who have multiple, family dynamics, can divorced parents apply for the different loan options for the same billing period? So in general, when you're looking at divorced or separated parental situations, each parent, let's say you decide to split up the bill 50-50, just as an example. Each parent can pay for their portion however they want. So if you want to take out a MEFA loan for your portion, it will be a separate loan. Then the other spouse can either do a payment plan or cash or take out their own loan. But you do want to take out separate loans in a divorced or separated situation. And that's very common for students to have multiple payment plans on their account or multiple loans for different family members. So you can definitely do that, and colleges are definitely used to working with that situation. So a question about consolidating loans. It really is up to you to decide when you want to consolidate. Again, I can't speak to federal loan consolidation right now. That's a whole separate webinar about federal loan repayment and consolidation options. But with refinancing, at least through MEFA, the loan has to be in repayment and the student have graduated or left school to do any refinancing. So it really depends on, what the rates are looking like for you to do that research. So good question here about unbilled expenses for off-campus housing, for example. Excuse me. Do you have to talk to the school to get a refund for this money? Will MEFA pay you directly for this money? All the money for MEFA, federal direct loans, we always send the money to the college. So you do need to work with the financial aid office to get a refund for the unbilled expenses, and they can refund you a portion of that MEFA loan, but it does have to come from the college. So timing wise, if you're looking for a refund for off-campus housing, for example, usually colleges will do that after the bill's been paid, they've applied the loan to the bill, talk to them ahead of time so they know, because they'll have you coded as off-campus expenses. They'll have you coded in that billing. And so they know that you'll need those funds. But you do want to talk to them to find out how much you need, and they will give you that refund directly. But the timing is where you want to, just be cognizant of the timing, because typically colleges are going to do refunds after the add drop period, which is usually early to mid-September, depending on the college. So you might need to pay for September rent, for example, August rent upfront, and then kind of reimburse yourself once you get that loan refund. So just be aware the first month, just be prepared to pay for that out of pocket and get refunded from the MEFA loan directly from the college. But that's a really good answer, really good question. So I'm going to leave it open for another second or two to see if anybody has any questions. We're at the hour mark, so I like to make sure that folks can get back off their lunch break and get back to work if you need to. But with that said, we are going to send this recording to everybody who registered and send the PowerPoint slides along with that. So feel free to take that information, call us or email us if you have any questions, and be in touch with MEFA. And we are happy to work with you, and good luck in getting through this process and trying to do it with as minimal amount of debt as possible. So thanks everybody, and have a great day, and we hope to see you soon on another MEFA webinar.